Good afternoon, everybody. Welcome to Where Do We Go From Here, one of the latest offering from CFA Society Minnesota. Trying to make sure that all of you good folks out there are continuing to get the professional learning opportunities you are looking for, despite the fact that we can't be in person to do this sort of stuff. So my name is Mark Salter. I'm the Executive Director for CFA Society Minnesota. And I get the happy task of kicking things off, but you're not going to hear from me for very long. The biggest thing I want to do is to do a couple of really quick thank yous and do a quick housekeeping thing. So first of all, thank you to Joyce and Bernard from American Century Investments and their colleagues, Walt and Joe, who are on the call. Thank you, guys. I want to thank you to our annual sponsors. Megan, can you see if you can freeze that screen or go back? There we go. The firms you see on our screen, we can't do this kind of stuff without folks like American Century and without our sponsors who give us every year of their time and talent and treasure, their thought leadership to make sure that we can do things like this. And we also want to thank CFA Institute. Some of you already know that when the pandemic broke out a few weeks ago, the Institute rushed to the aid of all of the CFA societies around the world, offering a Zoom meetings license so that we can keep meeting like this. So with all of that, Megan, go ahead and stop sharing your screen, if you will. And so I'm not sure what you guys are seeing right now, but I'm going to stop talking in just a second and turn it over to the folks from American Century. The one housekeeping thing I wanted to mention, there we go, we've got the slides starting up now. The one thing I wanted to mention is for Q&A. We don't have a robust Q&A feature as part of the meetings platform. So what we do have, we will use, and that is the chat function. So if you've got a question for Bernard and Joyce, please put it in the chat area. We'll be monitoring that throughout. And at some point, I hope we have enough time to get to some. If we never get to all of them, but we'll get to as many of those questions as we possibly can. So with that, I'm going to turn off my screen. Joe's got control of the slide deck, and Joyce and Bernard, it's all on you. Take it away, and thank you again.
I might slide right in there, Mark. Just to tee things up, if you don't mind. Hello, good afternoon, everybody. It's Walt McGhee from American Century Investments. Thank you so much for joining us. I wanted to, again, thank Mark and Megan for the kind invitation to present to you today on where we go from here. I am a vice president on American Century's global institutional team, where I head up our new business development efforts in the central United States. And I'll be moderating today's call. And the purpose of which is to provide you with a timely macro perspective through the lens of two of our most senior client portfolio managers. The format is that I will introduce Joyce and Bernard, tell you a little bit about what they do at the firm, and they'll each speak together, I think for maybe 30 minutes on where we go from here. We've done this presentation in Atlanta. We've done it in St. Louis. And I think they have a special version of this presentation for the Minnesota Society this afternoon. But they're going to give you their perspective on what's going on, a global perspective given the COVID-19 pandemic, the sell-off, subsequent volatility, and then of course we'll open it up for Q&A. So let me first introduce our speakers for this afternoon. Joyce Huang is a vice president and senior client portfolio manager with American Century. She's based in New York, and she's responsible for representing American Century's fixed income strategies and results to our clients around the globe. And she offers 14 years of experience with firms such as Lehman, Barclays, BNY Mellon, and we were lucky enough to bring her to American Century in 2018. Joyce earned her BA in economics from the Wharton School at the University of Pennsylvania and is a CFA charter holder and member of the CFA Institute. And we always like to tell you a little something interesting about our speakers. And she tells me that during the quarantine, she's picked up a new hobby, which is baking sourdough bread. So, and then we are also having Bernard Chua speak to us today. Bernard is a vice president and senior client portfolio manager with American Century, and also based in our New York office. And Bernard is responsible for representing American Century's global growth equity and ESG strategies and results to our clients around the globe. And he offers 34 years of experience from firms such as American Express and UBS and Deutsche Bank, and he joined American Century in 2006. So Bernard earned a BA in economics from Manila University in the Philippines and a master's degree in economics from UC Santa Barbara. And he, of course, also is a CFA charter holder and a member of the CFA Institute and New York Society of Securities Analysts. And so his fun fact that Bernard shared with me is that during the quarantine, he told me that he found himself listening to a lot of music from his favorite decade, which was the big 80s. So in addition to benefiting from their perspectives on global capital markets, you're free to follow up with either of them on about their favorite recipes or your favorite 80s band. So, so with that, let me introduce and hand the presentation over to Joyce and Bernard, and take it away from here. Thanks so much.
Great. Thank you so much, Walt. And thank you so much, everyone, for joining us this afternoon and taking the time. If we can move to the first slide. You know, it's hard to decide, you know, where we can go from here without talking about really where we came from. So I think it's worth spending a few minutes up front sort of highlighting the growth trajectory of the last expansionary period, which we finally got confirmation ended in February 2 weeks ago, even though I'm sure all of us already kind of knew that was coming. So the interesting thing is that, you know, as Bernard and I have been doing these macro presentations for a while, even starting at the end of last year, our tone was pretty cautious. And it's not because we anticipated there was going to be the coronavirus or a huge market sell-off that we've never kind of seen before to these levels. But if you look at the trajectory of the last growth cycle, one thing you'll notice compared to previous expansions is that it's extremely shallow despite the record length that we had, right? So what this means is we did not achieve the same aggregate level of growth that we did in this cycle versus some of the other longer cycles that we've seen over the last few decades. The other thing to point out is that this last cycle was primarily driven by easy monetary policy. Does that sound familiar? Is this something that's foreshadowing the future? We'll talk a little bit more about that later. So next slide. The sell-off this time was also unique because the market narrative rotated so quickly. You know, we hit peak to trough in less than a month. Compare that to a sell-off like the global financial crisis, which really took, you know, almost 9 months for us to hit the bottom. Now, despite the slowing economy and the weakening fundamentals that we talked about that we were already seeing heading into this year, you can see that during the first quarter and even now, it was almost 100% correlated market performance to the virus, right? So those issues didn't really come into play again. It was really primarily driven by news about new cases of the coronavirus. And you can see here that the peak of the number of new cases in the US corresponds directly with the bottom of the S&P back in March. So even though the spike in confirmed cases has dropped recently, you can see that that has also continued the correlation, where this market rally of the last 2 months has really been tied to optimism about the reopening and the gradual slowing of cases. However, you can see in the last week, we've again reached high correlation with the virus news, where we've seen spikes in some of the states that have reopened earlier, as well as in China, right? Next slide. So looking at this virus effect on GDP forecasts and growth, you know, as expected, Q1 did not capture the full effect of the virus lockdowns here in the US, given that we didn't really start seeing large cases of infections here in the US really until March, right? So you can see that Q2 is really where we anticipate the bulk of the virus effect is going to be priced in. So you can see that, you know, Q2 took a huge drop as soon as we realized that the virus was not going to be, you know, 1 or 2 weeks. It was going to be more severe than that. But then more interestingly, you can see how the second quarter forecast took another dip as record unemployment numbers began to come out and the severity of the aftershocks of the virus began to get priced in. Now, it's interesting to note that while Q2 forecast took a dip, at the same time, Q3 jumped up as the economic recovery was pushed out further this year. So originally, people were thinking, okay, the lockdowns will last for a month maximum, and then we'll have a V-shaped recovery, and everything will be fine. And that hasn't really been the case. And you can see that being priced into the market, where people originally thought the Q3 recovery is going to be more mild, but then as the virus timeline got pushed back, the Q3 expectations got pushed up, as well as Q4. And our view here at American Century is pretty consistent with the market sentiment, but we are probably a little bit less optimistic in calling for any sort of V-shaped or even shallow U recovery. Next slide. So of course, we can't really talk about the recovery or market performance during the coronavirus sell-off without touching on the record monetary and fiscal stimulus that's been a huge tailwind for risk assets this year. It's not a coincidence that, again, along with the bottoming of equity markets here in the US, it coincided with not only a peak in COVID cases, but also record Fed interventions. So you can see here that the value of fiscal stimulus has also been unprecedented. You know, in Japan, it's over 20% of GDP. In the US, it's already 12%. You know, we expect to see additional stimulus as well. You know, there's been talks about the next generation EU plan, one of the first coordinated responses, a fiscal package from EU countries. Not surprisingly, there's EM countries on this list. EM countries are not really known to do monetary and fiscal stimulus. So it just goes to show you how widespread and deep the effects of the coronavirus have been worldwide. Let's move to the next slide. Now, let's look at some of the more positive signs that we are, in fact, in the recovery period, and we're not looking at a W recovery per se. Now, thinking about unemployment, you know, even though we're talking about these numbers all the time, I'm always shocked when I look at the graph and look at the numbers represented graphically. It's truly unlike anything we've ever seen. And it makes the global financial crisis, which at the time felt extremely painful, and the effects of that lingered for a number of years afterward, it makes it look like a blip on the long-term record of unemployment numbers. So that is just another proof that our economic models and forecasts and everything are really good at factoring slowdowns and growth periods. We don't have experience pricing total shutdowns. You know, this was completely unprecedented numbers of unemployment. Now, the positive news is that we do see numbers retracing as reopening happens across the country. So that is one positive sign. Next slide. Now, the chart is interesting, right, just to look at overall unemployment, but we think that you really have to take a deeper and different slice at it, because you have to look at what the future holds for working and office life and things like that. So we wanted to look at jobs that can be done from home and can't be done from home or remotely. And not surprisingly, when you look at the top 5 sectors and the bottom 5 sectors, you know, it's not surprising that the sectors where you saw huge surges in unemployment are the same sectors where you can't do your job from home, like hotel, leisure, food services, restaurant work. You know, it's kind of impossible to virtually wait on a table, you know, through Zoom, like we can do here, luckily. So when you look at the actual wages, though, if you look at the types of categories you can work from home, those tend to be the professions and jobs where the average wage is higher than the bottom 5. When you're looking at retail, construction, food services, farming, things like that. So one of the more positive takes on this data is that as the work from home becomes more of a normal part of our lives and our economies, the higher paying jobs are the ones that can be done remotely. And so the aggregate effect on consumption will be more modest than if you look at the overall unemployment numbers. And, you know, that leads to opportunity, which Bernard's going to discuss a little bit later. Next slide. So another positive sign is the trend in high-frequency data that we saw in Europe, given that Europe began its reopening earlier than we did here in the U.S. You know, we see the uptick in April PMIs, and even in the U.S., with states reopening in waves and in different fashions, we see that there has been a huge spike in food and retail sales as people have pent-up demand rushing to shop and eat. I know when I'm in Connecticut, and when we reopened, I was very happy to be able to sit outside and enjoy the weather and have some dinner at a restaurant for the first time in 3 months. Next slide. Now, if we want to get a better look at what our future holds, I think it's interesting to look at China, right? So China was obviously the first country affected by COVID-19 and the first to reopen and to really eradicate the virus, except for some new cases that we saw this week. You know, while there has been a bounce back in some high frequency indicators, we look at flights. We're looking at coal consumption to look at production. You know, we can see that they haven't rebounded to pre-COVID-19 levels. And, you know, especially touching on the production side of China, you know, it still remains to be seen how sustainable the demand jump will be from other markets who are going to be importing these goods that China's producing. So these factors, again, make us believe that we are in the more extended U shape rather than a V or any sort of quick recovery. Next slide, please. So another issue that we are facing that makes us stay a little bit more cautious is the debt that's been undertaken not only by governments, as we touched on, to fight the coronavirus, but by companies over a long period of time. And we all know there's no free money in this world, and companies are starting to face their reckoning as they took advantage of a decade plus of very low interest rates, courtesy of the Fed and the global financial crisis, to borrow money at extremely low rates. And these high debt levels have really affected the ratings for companies, as the shutdown for many of these sectors has sharply decreased revenue. And now a lot of companies are facing unserviceable debt ratios, which have caused downgrades. And the scary part is that the number of fallen angel companies, which are companies that were previously investment grade, being brought down to high yield, you can see that the number of companies already downgraded halfway through the year have already far surpassed what happened in previous crises, like the oil sell-off back in the end of 15, beginning of 16, global financial crisis, and the dot-com bubble. So next slide. Now, looking at fallen angels versus defaults, fallen angels are on the upper end of the high yield spectrum, and defaulting companies are at the bottom of high yield, right? And unfortunately for the outlook, defaults tend to be a lagging indicator, right? So companies will try to hold on as long as they can, and then usually after the crisis hits, they won't be able to pay their coupons, and then they will officially default. Now, it seems like the worst is yet to come. As we pointed out, defaults are a lagging indicator. We are nowhere close to the levels that we saw in the global financial crisis or in the dot-com bubble. And it looks like we could be getting there, especially as the coronavirus and the working from home effect, as Bernard will talk about a little bit more in e-commerce, has changed fundamentally some sectors and some companies, and their business models are no longer sustainable. And I'll turn it over to Bernard.
Thank you, Joyce, and thank you all for joining us. So my comments are going to be more tied to what's happening in the equity market. So if we turn to the next slide, looking at earnings, obviously the COVID health crisis has negatively impacted earnings. Corporate earnings were actually starting to recover, coming into 2020. Earnings revisions were starting to turn up, albeit at that shallow trajectory that Joyce talked about earlier. But the COVID crisis obviously created one of the most severe shocks to the global economy, and then also to corporate earnings that many of us have ever lived through. And the severity of the shock in terms of depth and breadth, as Joyce pointed out, is much worse than the financial crisis, the global financial crisis. So the word unprecedented is a very, very appropriate word. Almost every company has been impacted to some extent, and all companies had to react one way or the other. Many choosing to adopt quote unquote survival strategies. And what does that mean? Many choose to preserve cash, basically to be able to fight another day. So what we saw were companies deferring their dividend payments. We saw companies halting their stock buyback programs. We saw companies postponing CapEx plans, and then at the most extreme case, outright laying off employees. So when we fast forward today, we are now at what I would call a fragile inflection point. So the negative trends appear to have bottomed sometime in April, and we're starting to see many parts of the US, Europe, starting to see initial signs of improvement or inflection points. So ultimately, corporate profits will follow and will recover. If we turn to the next slide, please. The impact on earnings has so far been uneven. Different businesses have been impacted very differently. Earnings for many cyclical industries, you can see some of those on the left-hand side of this page, were hit the most. And then many of those other businesses that are less tied to cyclicality, that are more being influenced by, let's say, secular drivers, secular tailwinds, those businesses have held up a little bit better. So on the left side, you'll see industries like transportation, you'll see industries like the auto sector having had the most and deepest negative revisions to their earnings. Banks were also hit hard as interest rates fell, and concerns that the slowing economy might result in rising credit risks. So those types of cyclical businesses were definitely on the end that had been hit the most from an earnings expectation perspective. On the right-hand side, you see earnings also revised lower, but remain on the positive side. So healthcare is a good example. Healthcare, the broadest definition, which would include biotech companies, which would include pharmaceutical companies, all the way to companies that make tools and equipment, diagnostic equipment. Many of these are going to be positively impacted as the world continues to look for cures for COVID. Consumer staples as a group have also held up well. So think of companies like Procter & Gamble, think of companies like Nestle. So many of these FMCGs or fast-moving consumer goods companies did well, mainly as a result of consumers stocking up their pantries, right? So we saw this big pantry stocking impact. People started buying things like paper products to packaged foods. So that's contributed positively to many of the earnings of these types of company. And then finally, technology. So as a group, also benefited. And technology, a wide range of tech companies that have done better, ranging from companies that are involved in tech infrastructure to companies that provide software solutions. If we turn to the next slide, a good example of this area of technology is obviously e-commerce. Penetration of e-commerce has been rising consistently, and you see that big spike at the end there. Amazon.com, contrary to many companies in the US, actually had to go on a hiring spree just to meet all the demand on their services. The company in the months of March and April had to go out and hire 175,000 people, and they also had to increase hourly wages to attract these people, to basically just satisfy the demand for their services. And it's not just Amazon, it's also a lot of e-commerce companies around the world, and companies, even bricks and mortars companies that have been very successful addressing this move to e-commerce. A company like Walmart. Walmart reported very strong earnings that were driven by e-commerce sales. So not every bricks and mortars are suffering. Some of them have responded very nicely to the threat. E-commerce sales for Walmart rose 74% last quarter. They reported a 74% growth. And so this whole e-commerce trend is continuing, and COVID is actually creating an extra catalyst for this. And in addition to just companies like Amazon, companies like Alibaba in China, ancillary businesses tied to e-commerce, such as e-payments, electronic payments, from credit card companies to other forms of alternative payment software providers, have also done really well during this period. On the flip side, you can imagine bricks and mortars businesses, many have started to file for bankruptcy. A lot of the, if they were on the edge of the precipice, COVID just pushed them over, right? So we've seen bankruptcies, bricks and mortars retailers, like JCPenney, J.Crew, Neiman Marcus, Pier 1, these companies just filed for bankruptcy. But it's not just retailers, it's movie theater chains, it's department store chains, it's restaurant groups. So COVID is accelerating a lot of the trends that we know and that we've been observing, but COVID basically became another catalyst that kind of accelerated that process. Then turn to the next slide. Another beneficiary of what's going on is cloud computing. Public cloud infrastructure as a service is expected to grow by an annual rate of 29% to reach 177 billion by 2024. So right now we're around the 50 billion level. So the demand for cloud computing should continue. Companies who have not yet made that decision to move workloads to the cloud will likely find COVID and the economic shutdown a catalyst to do that, right? So the idea of moving your workload to the cloud is really a cost savings initiative. So migrating workloads to the cloud is estimated to lower the cost of running Windows workloads by 56% over 5 years. So that's research that's done, and there's plenty of evidence that suggests that, you know, going the route of cloud computing brings down the cost of IT expenses. And the beneficiaries here are not just the companies like Amazon's AWS business, not just Microsoft's Azure business, but also the companies that support the backbone or the infrastructure of the internet. So we're talking about businesses ranging from data centers to equipment companies that manufacture 5G equipment. So the COVID crisis is creating an environment where you're having companies that benefit and also companies that basically are being pushed to bankruptcy or are being pushed to slowing growth. The last point we want to make before we turn to Q&A is the outlook for interest rates and specifically inflation. This is going to be very important when it comes to capital markets. If you look at the next slide, you know, what does this look like on the other side of COVID? So let's look at the case for higher inflation. The case for higher inflation is really falls on the idea that the amount of debt that we have taken on as economies or countries has been staggering. You know, we won't argue that this is a bad thing, because it is necessary given the health crisis, right? That central banks provide this liquidity. But at some point, it is possible, it's not automatic that it will be inflationary, but it is possible that it might lead to inflation, right? This liquidity could ultimately lead to higher prices. Ultimately, the cost of servicing debt loads could become problematic in the future. The other thing that the virus did was it reminded businesses of the risks of the global supply chain, which ultimately threatens the idea of globalization. The prior to COVID, you already had these little bits of risk areas, such as the rise of populism, the risk of tariffs and taxation. A lot of that kind of put into question mark, you know, why do we have all our supply chain scattered all around the world? And then now COVID increases that risk, right? So while this most likely will play out over the long term, deglobalization can be inflationary as manufacturing is brought back onshore. And then finally, on the inflation side, we're already starting to see the signs, at least on the short term, signs of higher food prices like meat products. We're starting to see the impact of higher rents and healthcare services. To a certain extent, many of these are being impacted by the COVID crisis. If we turn to the next slide, the flip side argument to this is that the case for low inflation is centered around the idea that savings rates, even prior to COVID, has already been rising. And the pain caused by the global financial crisis, the aging baby boomer, have been pushing savings rates to rise in the US. COVID just adds to that trend. And you can see this big dramatic spike. You know, partly this is obviously not sustainable. People will come out and consume again, but COVID will likely add to a list of reasons why people will be saving. And then the other thing is the world has not really seen a lot of inflation, even though we've been 10 years into an expansion. The fact is low inflation is not just a US phenomena, but a world phenomena. And part of that is that central banks around the world have done a very good job targeting inflation. You know, this whole program of targeting inflation has been very successful, where if you look at the median CPI globally, and you take an average of CPI across all the countries in the world, it was around 17% in 1974. Today, it's less than 2%, right? So the idea is inflation is very difficult to come by these days, and most likely that'll continue. And then finally, obviously, technological advancements led by automation, digitization, are also bringing down the cost of many things. So what's the inflation conclusion? So there's many different sides to argue both high inflation and low inflation. Our view is that over the short term, inflation may spike higher, especially as economies reflate and economies turn on their growth engines again. Business activity should pick up. A little bit of inflation is not bad, especially if it is a result of economic growth. But over the long term, it is less clear. Given the strong structural forces at play, including technology and the aging demographic, that is up to debate. So what does this mean? It's clear that many of the things we talked about here will combine to introduce elevated levels of uncertainty, elevated levels of volatility post the COVID world, which is why we go back to the idea that this is an environment that really justifies active management, not just in the equity space, but also in the fixed income space. So with that, I will stop and see if we've got any questions.
Thanks, Bernard. That was, and Joyce, that was very interesting. Sorry for the bit of delay there. I was having trouble unmuting myself. We do have a couple of questions that have come in. And maybe I'll start with, given your comments on inflation, but what are your expectations, each of you, for additional stimulus?
Yeah, so that is something that we think would be a continued tailwind for global risk assets. I think it's pretty clear that given what's been going on with U.S. cases resurging and an uptick in uncertainty around, unemployment is down, but again, still at record levels, we strongly believe there's going to be a phase 4 stimulus, and it's going to be primarily targeted at states and municipalities and infrastructure, less so the direct payments to people that the earlier phases had. But one thing that would be good would be for municipals and other asset classes like that would be that aid for state and local governments, infrastructure investments, just more spending. And we believe the timing for that is going to be prior to the November election. I think that is going to be almost certain that there will be the phase 4 stimulus. And then again in Europe, with the next generation EU plan, that's really going to be the first time that we've seen a united fiscal stimulus effort by all the countries in the EU. And that should also be, if it's not watered down by any of the countries, it's going to be record breaking as well. So I think there is still going to be quite a bit more stimulus to come, but we have to weigh that against the risks of, round 2 of cases and further lockdowns, or consumer demand not recovering quite as quickly as near-term data is suggesting.
Interesting. Thank you very much, Joyce. Speaking of elections, Bernard, how might those impact the equity markets?
So elections typically will sway performance, and usually the area, the sector that is most impacted is healthcare. That's an area that has really done well, but almost always politicians love attacking, the price of medicine, the price of care. The healthcare risk is not as pronounced as it was when Elizabeth Warren and Bernie Sanders were still viable candidates. Joe Biden is not as supportive of the concept of Medicare for all, so that expectation is probably lessened, but clearly there will be focus on prescription pricing and prescription reform. This could be a headwind, and so from a portfolio perspective, it probably doesn't make sense to have a lot of exposure to these businesses, but not everything in healthcare is going to be equally impacted. So there's a lot of things where price controls are not going to be an issue. So think about basic stuff, basic hospital supplies like syringes, IV bags, or interventional cardiovascular treatments. These are things that are not historically impacted by price control. So that's probably a safe place to hide, especially in the period like, now that we're in election season. The one thing to note is if we do have change in control and the Democrats take over not just the presidency but the Senate, then the issue of what they do with taxation is going to be very important. Given all this debt that the country has taken on, Biden has already said he wants to increase taxes, and that could be negative on the market sentiment. That could be negative on corporate profitability. So that's clearly something to be paying attention to. But again, we have a few more months to elections.
That's interesting. Thank you very much. We have one more question that has come in, and so I think we have time for one more. But the markets certainly have rallied since the bottom in March, and yet economic data suggests that we're still in the midst of a pretty deep recession. So the question is, are the markets ahead of themselves?
So Joyce, I'll take a shot at that. So from the equity perspective, we can't really say markets are cheap. Forward multiples on the S&P 500 on an absolute sense compared to its own history is on the high side. To an extent, it makes sense why the S&P is trading this high, partly because the discount rate is very low. There's obviously an inverse relationship between interest rates, valuation, inflation, and valuation as well. When inflation is low, we are seeing we're seeing now. Interest rates are low. The S&P tends to trade at a higher multiple, so that kind of makes sense to us. And then there's also the argument to be made that the composition of the markets today is heavily tilted towards many tech companies. And many of these tech companies have very predictable earnings growth profiles. And so the market is assigning higher multiples to these types of companies. But having said that, even though it kind of makes sense, it still warrants a lot of prudence. Investors should be very, very cautious, especially now that the market has run up, especially individual companies have run up pretty strongly. And a lot of that has to be weighed according to fundamentals and earnings growth. So, market's not cheap, which again comes back to our original argument that this is an environment where you might want to have some more active management to your portfolios.
Right. Thank you. Well, we have no more questions in queue. So I want to thank all of the people that dialed in and zoomed in for the American Century Where Do We Go From Here presentation. We're always delighted to work with the CFA Minnesota. It's really quite an honor for us to participate in these types of events. So thank you all for having us today. If there are any questions or follow-up that you'd like, please feel free to reach out to me. Mark Salter knows how to reach me. My email address is Walt_McGhee, McGhee @AmericanCentury.com. And we look forward to maybe doing another one of these for you sometime later in the year. So again, thanks so much. Mark, did you want to put a bookend on this in any way, or shall we sign off?
I will just echo the thanks. Thanks again to all our friends at American Century, and thanks to all of our folks for dialing in. We'll be back again in the near future with more stuff to keep you up to date. So appreciate it. Thanks, Walt. Thanks, Bernard. Thanks, Joyce.
Okay. Goodbye, everybody. Stay safe.
Everyone.